Yeah, so at Munro Partners, we do global equities and we do growth. So that ultimately means we're trying to find a selection of the best companies in the world that are growing their earnings over time, and we think their share prices will follow. That's what we mean by growth equity investing. So our edge is if we're trying to find companies that can grow faster than the peer group, then they need to be leveraged to some sort of structural change. We like to call this the S-curve. If you're not leveraged to some structural change that is moving along this S-curve, then ultimately you're just going to grow in line with the economy. So what we do is we identify these areas of structural change. We call them AOIs, or you could call them themes. Things like high performance computing or shifting to the cloud or changes in the way we administer health. And once we identify these areas of change, we then identify the companies that are most likely to benefit from them. Those are the companies that will exhibit the structural earnings growth we're talking about. That structural earnings growth should equal share price growth, which will ultimately drive the returns of our funds. So we're talking about the Munro Global Growth Fund, which is the fund that is our absolute return fund. So in this case, we're looking to deliver double-digit returns for our clients, but with downside protection. So the absolute return fund, it uses our proprietary strategy here at Munro to pick the world's great growth companies, but it also does that with a view to protecting the downside. We protect the downside with things like cash and put options and short selling. What we're aiming to achieve with this fund is double-digit returns through the cycle on a 3 to 5 year view. So clients should think about that as more than 10% per annum after all fees and expenses on a 3 to 5 year view, with volatility less than the market. And thankfully, the fund's been able to achieve all of those objectives since inception. So as we enter the second half of the year, hopefully we'll be calmer than the first half of the year. We entered 2025 feeling it would be the third year of a bull market. And so we expected double-digit returns for market, but definitely not as strong as what we'd seen last year or the year before, which were the first 2 years of the bull market, where generally the best returns are achieved. But within this year, we still expect double-digit returns and maybe with a little bit more volatility. What we've seen in the first half is we definitely got the volatility, but ultimately equity markets have found their way through. We are becoming more used to the Trump agenda, or I suppose more immune to it. It's more well understood and priced into markets. And interest rates are ultimately staying benign also. So this is allowing the corporates to ultimately do what they do best, which is follow their earnings growth. As we move into the second half of the year, rates are probably likely to be cut. And if anything, the market's going to start to price in some more earnings growth acceleration in the second half of the year. We're already seeing that happen, particularly in the AI part of the market and the artificial intelligence enablers part of the market. And we'd like to see that broaden out as the year goes on. So from our point of view, good to get through the first half, good to get through with positive returns. Hopefully those positive returns can improve in the second half of the year. So at this point in time, artificial intelligence, the enablers of artificial intelligence and the beneficiaries of artificial intelligence still make up a good chunk of the fund. Ultimately, these were the stocks that got overbought at the start of the year, but gave us another really good opportunity to buy them through the Liberation Day sell-off. And if anything, they stand out as a bastion of strong growth acceleration in the market today. And so that is definitely the main area of the fund today. But as we move down and as we move into the second half of the year and get some of these rate cuts, we'd be looking to build out in some of these other areas of interest around infrastructure building or the onshoring that's going to happen in the US, and then even eventually around the consumer part of the consumer ideas within the portfolio. And so as we get close to the end of the year, you'd expect our positioning to broaden out somewhat. But as we sit here today, AI has been driving the fund for the first half of the year, and we expect that to continue in the second half of the year, but hopefully with a few other contributors along the way. Yeah, so why is this AI still driving the market? You know, it's been around for 2 years now, yet it's still continuing to drive these biggest players. The reason why this is happening is because we're effectively having, you know, an industrial revolution type build out of AI capacity. We should think of this as the intelligence revolution. Huge data centers are being commissioned and built, particularly in the United States. These are megawatt, gigawatt projects. And to give you an idea, a 1 gigawatt data center is $50 billion of capex invested. We're now seeing the 4 biggest companies on the planet, the hyperscalers, investing more than $450 billion just this year alone on data center spending. So that's more than 1.5% of US GDP. And so from that point of view, this is an investment boom, and we are positioning the fund to benefit from that boom. The main place we're doing that is in high-performance computing, and there in high-performance computing we're benefiting with companies like NVIDIA, which has been in the fund for a long time, and also a number of the other players that help build out these data centers or help provide the semiconductors for these AI factories that are getting built out. But the next area that we think looks interesting as we go on in the digital media and content in particular is now that AI is working at scale, who's going to be able to leverage it? And the companies that we think most able to leverage it are these digital media companies. So these are companies like Meta, like Spotify, and like Netflix. We are seeing these companies being able to really improve their engagement based on the AI tools that they have. And that improvement in engagement is equaling better subscribers in Spotify's case, better advertising conversion in Meta's case, better eyeballs in Netflix's case. And we think we're just at the start of this. We think we'll be able to continue to find companies that can apply AI technology to vastly improve their businesses. And this is what we think will be a happy hunting ground actually for years to come.